Good morning, good afternoon, good evening to everyone. Welcome to the G4A Roundtable, and thanks for joining us today. I'm Cliff Aaron, one of the founding principals of GreenMax Capital Group. GreenMax is the sponsor and fund manager for the Green-4-Access First Loss Facility, known as G4A, a new risk mitigation facility we are launching to partner with local financial institutions across Africa to scale up local currency debt financing for energy access. We've had nearly 150 registrants today, roughly 40% from donors, DFIs, and impact investors, and 16% from local banks across Africa. This is really an indication of the high level of interest in G4A, and especially what we've already accomplished in bringing local banks across Africa into the energy access finance discussion. I know you've all been to dozens of off-grid energy events. When have you ever seen 25 to 30 bankers representing 14 banks from 9 different countries attending one of these forums? We are grateful to our co-sponsors of this event, the Global Off-Grid Lighting Association, GOGLA, the African Mini-Grid Developers Association, AMDA, and the Global Distributors Collective, GDC, for all their support in the development of G4A and their participation today. We're also grateful to the Partnerships for Green Growth, P4G, for their support during the development of the instrument. We are also thankful to all of our panelists who will be speaking today from the World Bank, various PAYGO solar companies, and mini-grid developers. We've developed G4A with 4 basic premises in mind, and we hope we will convince you today that local financial institutions, LFIs, should play a critical role in meeting the SDG finance challenge. First premise, energy access funding needs in sub-Saharan Africa cannot be met without leveraging in private capital, and LFIs are one crucial part of the private capital ecosystem. 2, exchange risks create huge exposure for distributed energy services companies, and LFIs are best to provide local currency finance. 3, the off-grid sector is overburdened with on-balance sheet financing. LFIs can provide direct consumer lending to PAYGO customers to relieve this burden. And finally, African-owned energy access companies have struggled to raise capital, and LFIs are a natural match to finance companies from their own countries. Right now, we are deep in fundraising mode to bring G4A to fruition. The purpose of today's roundtable is to bring together our friends from the off-grid industry to explain directly to G4A's potential funders and other stakeholders exactly why this new facility is so needed and how G4A can catalyze finance for energy access. Our agenda today will be as follows. Most of the sessions will be held in a roundtable discussion format led by our moderators. At the end of each session, we'll take a handful of questions as time allows. Session 1, why is a risk mitigation facility for local currency lending so important for energy access finance? Our presenters will be Jan Excel and Tatia Lemonjava from the World Bank Off-Grid team. Session 2 will be a presentation made by our own team about G4A and how it works, presented by Sunkami Alowo and Koye Alaba. Session 3 will be our first panel discussion from representatives of the PAYGO market segment. It'll be moderated by Rowan Borst from GOGLA, with panelists Federico Hinrichs from GDC, Vivian Pat from Simusolar, Anton Aspira from Celebrian Solar, Remco van der Riet from Zola Electric. Session 4, our second panel discussion representing the mini-grid market segment, will be moderated by Joan Chahenza from AMDA, with panelists Ashish Shrestha from the World Bank, Jude Numfer from REI in Cameroon, Ricardo Ridolfi from Equatorial Power in Uganda, and Prosper Magali from Ensol in Tanzania. At 11, we will finish the formal part of the event. We decided to make an experiment and have an optional 30 minutes afterwards for deep dive Q&A on the G4A funding opportunity. Our whole GreenMax team will be present. Feel free to stick around and join for that. During that session, everyone will be unmuted and come on screen for a discussion. Finally, a few housekeeping notes. Please rename your Zoom screen to include your organization so everyone's clearly identified. If you don't know how to do this, my colleague Alex will write instructions for it in the chat. We'll be keeping, again, everyone muted during the sessions. During each session, please write your questions in the chat, and the session moderator will try their best to raise it to the panelists. And yes, the event is being recorded, and the recording will be made available to everyone who registered. We'll move on now to session 1, and it's my pleasure to introduce our panelists from the World Bank, Jan Excel and Tatia Lemonjava. Jan has spent a 28-year career in the clean energy sector, holding various positions with the World Bank, SNV, African Development Bank, REA in Tanzania, Ministry of Foreign Affairs of the Netherlands, and others. He's now well into his second tenure with the World Bank, where he is Senior Energy Specialist and Team Lead for the ESMAP Global Facility on Mini-Grids and Team Co-Lead for the Nigeria Electrification Program. Tatia is an Energy Specialist with the World Bank's ESMAC program, where she co-leads the ESMAC Global Facility on Mini-Grids. She's also part of several operational teams implementing large-scale lending projects in Nigeria and Ethiopia, focused on delivering electricity access through mini-grids and off-grid methods. So thank you very much, Jan and Tatia, for joining us. As we discuss, I'm going to ask a couple of questions for the panel to kick things off. Can you tell us a bit about what you've learned about financing energy access during your experiences with programs where the bank has funded results-based financing type grants for off-grid installations? Where the RBF is covering only a portion of the CapEx, how easy or how difficult has it been for the developers participating in the program to secure the balance of financing?
Thank you, Cliff. Can everybody hear me okay?
Yes, we hear you.
Great. So that's a very important question, obviously, and I can say it certainly hasn't been easy. As some of you may know, our team, which is led by my colleague Jan Excel, we are implementing the Nigeria Electrification Program. We're supporting the government of Nigeria with a $350 million program that has these RBF instruments, namely the minimum subsidy tender and the performance-based grant, which are both aimed to fill the viability gap that may be present for developers in entering the market. And with programs like these, and we're designing these types of programs in other countries at the moment as well, namely Ethiopia, the program that you've mentioned. Our goal is really to promote business as usual for developers and to let them lead in the market and follow their normal sort of behaviors. In order to apply for the program, they still need to have a viable business model and a financial model and secure their own equity and financing and debt financing. But our program basically fills what we call the viability gap between their cost of service and the willingness to pay of the local population. And so far, what we've seen from these programs is that there certainly is a huge gap in the availability of both local and hard currency. I mean, it's not a surprising situation for us necessarily, because we're at the very beginning of this, what we consider to be a hockey stick sort of ramp up of the market and of the sector. So for a lot of the local lenders, this is a completely new sector and a completely new industry They're not very familiar with it. For many of them, this is the first or second time that they're lending to a mini grid developer. So there's just a lot of risk that they perceive in the market, and that obviously is reflected in both the interest rates and the tenor of the loan that they are prepared to offer. So through the instruments that we have available to us, we try to design some like credit lines that we may make available to the local lenders, and a capacity building and training for both the developers in improving their business plans and their pitches to the banks and to the local banks, in terms of improving their risk perception for these types of loans. But there certainly is a very large gap still. So I actually have the numbers in front of me for the Nigeria program. And just to give you an example, at the moment under our performance-based grant window, we have about 375 systems that are in the pipeline, that have already reached, they're already in the system, in the Odyssey system, and they have agreements with the communities, so they're kicking off. And for 19 of these, construction has already been completed, 6 of them have been commissioned, but only 64 of the 375 have secured all of their debt and equity financing. So that's about 23 million. And there's a $100 million gap at the moment still that needs to be filled through these types of, that hopefully will be supported through first loss mitigation facilities and risk sharing facilities and things like that. So we're really very excited about this conversation that we're having today. And we're certainly very actively engaged with many different partners that offer. SRMI is one, IFC's FIG is another, and obviously this conversation today is very important to us. So yeah, I hope that answers your question.
Great, thanks, Tatya. And I see your network bandwidth is low, so I guess you can't come on screen with us just to explain for everyone why we can't see your beautiful smile today.
Oh, that's strange, because I can see myself. I didn't realize you couldn't see me. Can you see me now?
Yep.
Yeah.
Okay.
Great, thanks. So as a follow-up, what specifically has been the bank's experience in trying to secure participation of local financial institutions in providing debt finance for the off-grid sector? You know, what approaches have you tried, like credit lines or guarantees? Where have these succeeded or fallen short of your expectations? And at the end, what conclusions have you reached about what is really needed to engage LFIs in scaling up their off-grid lending?
So a lot of this question, I think, is very conclusive, and I don't feel that we are still at that point, right? I think a lot of this is a very nascent market, and I know I keep saying that, we keep saying that at all these different engagements that we have, but I think it's so important to keep that in mind, that this is not abnormal for any startup industry, for any new industry. This is very much the situation, and that is why we need these types of instruments and facilities to really support the scale up and help, especially in these COVID times, to really help these companies bridge that gap and get to that point where their demand is high enough and their customer base is large enough that they can then continue for a very steady, stable business, hopefully for 20 years plus. In terms of your question specifically, so we're trying everything at this point. We're trying to engage with where really our approach is piloting at scale. So we're really trying to engage with every possible partner that is interested and able to work with us and to support us in the sector. The countries that we work in, Nigeria, Ethiopia, DRC, many other countries, there's so much interest, there's so much enthusiasm. Everyone, all the development partners are trying to figure out what are the instruments that may work. So from that perspective, it's a very exciting space to be in. Whatever instruments we have available to us, like credit lines, we do try to make them available through certain programs, but there are some constraints there as well. And the same issues do remain still, the hesitancy on the bank side, the need to bring them up to a comfort level where they understand how they can deal with this type of risk and how they can, what proxies can be used for demand, for example, for consumers and things like that. So as I mentioned, SRMI is one instrument that we are really focusing a lot on. The first loss guarantee facility is another fantastic example, obviously, especially in the COVID situation. I think it's such a great example of what can be done to really help them bridge that 1 or 2 year moment where it's a difference between bankruptcy and a steady business. The FIG program that I'd mentioned that IFC is promoting, it's not specifically for mini grids, but it's for all SMEs, but mini grid developers are also eligible for that. That's a 50-50 risk sharing facility, which is also a very interesting and hopefully very successful program, but it's still very much at the beginning. So yeah, I think we're really open to experimenting and trying out very many different approaches, and we're very eager to see and keen to see all these partners coming into the sector. But yeah, just to reiterate, I don't think any of this is unusual, right? I think this is a very hot sector, and it's expanding and rising very quickly. So what we want to see is exactly what we're seeing, the conversation today, and just the amount of interest that you had mentioned just before. I think it's very exciting for us, but also not really surprising. We have so many developers applying for the program in Nigeria, and many more reaching out to us asking about other markets, DRC, Ethiopia, Sahel, and many different markets that 5-7 years ago we couldn't have imagined that so many private developers would be keen. But like you say, we cannot get to SDG 7. We cannot get to 2030 without private sector, very active private sector engagement. So this is exactly the conversation we want to be having.
Okay, great. Thanks so much. I guess for our audience, Jan Excel got called to a management meeting at the last moment, so he wasn't able to join. We can take 1 or 2 questions for Tatia from the audience before we move on to the next session, if there are any. Okay, I don't.
Please submit questions in the chat for this purpose.
I see that Jan has joined us as well, so I think he might be available to answer questions.
Okay, Jan, welcome. Tatia has done a great job answering the questions, but if you want to add a couple of short words before we move on to the next session, that'd be great.
No, very little to add. But I just want to reiterate that we really encourage initiatives like this. The challenge is there's still 600+ million people that are without access to electricity. We do see a new industry, new sector emerging around decentralized renewables and the mini grids in particular. And with the cost projections going forward, the value proposition is only getting better and better. So in that sense, the market is the limit, and that means that significant more viability grant funding is needed, and with that affordability grant funding, but that needs to be complemented by private and semi-commercial financing. And I think that once that starts to flow, that's when you really can see the economies of scale and the exponential growth curve. So that's where initiatives like this, in trying to find ways on how to get this semi-commercial financing into the place, in particular the local financing, through risk mitigation measures, to maybe parallel financing, to capacity building. We're completely on board on that, and very keen to be part of the discussion.
Great, thanks, Jan. We have one question from Max from CETA. It's not directly related to finance, but it's an important question. How do the programs integrate the need to build demand and load to make the mini grids viable with a minimum subsidy?
No, it's essential. I think this is where the rubber hits the road. At the end of the day, we're not here to just get electrons flowing, but really to have, with the electrons, make a difference in people's lives, as well as in the lives of businesses. So if we manage to get wires out there without having demand being created, then we have failed. So we really have learned that the demand stimulation programs need to be designed early on in the process. So not when the wires and the panels go into the businesses and households, but about a year, 1.5 years in advance. Also not too early, because then you will have communities and business leaders complaining that electricity has been promised for many years now. So it's a delicate balance there. But it's critical to have these demand creation programs there, focusing on productive appliances, working with the appliance suppliers, as well as the microfinance institutions, the end-use financiers. So that should be number one. Just design and come up with the right sites, the right selections of the portfolio, your normal marketing and promotion, pricing studies, demand, linking to the demand. However, in many of our places, you continue to have an affordability gap. And so that's where the subsidy levels come in. And there, what we have learned is try to stay away as much as possible of operational subsidies, but focus very much on providing the subsidies on a result basis linked with the capital investments. So bringing the capital investments down, the operation costs for these systems are now relatively small, so you should be able to have those recouped through retail tariffs. Yeah, so it's a complicated field, but that's basically roughly how that pans out. Katja, is that more or less?
No, absolutely. I think that's a very good point. I'm also conscious of the time, so I'm not sure if Cliff needs to move to the next session, but absolutely.
There's one more, well, there's a couple of more questions from,
go ahead.
Is there a difference between the needs for mini-grid developers and off-grid solar companies? I think means the financing needs.
To a certain extent, no. I mean, that's also what Tatjana was mentioning. This is really new industries, be it selling of soaps, electric vehicles, or welding machines, is not much different from off-grid companies or solar mini-grid companies. So in that sense, ideally, you just want to have that equation where the private sector does what it does best, and that is coming up with innovative ideas, preparing business plans, scoping out the market, and then raising the financing. And that is a combination of equity and debt in a completely commercial situation. And in our cases, in our countries, working with the poor as a target group, there's also the viability gap issue that needs to be addressed. And that's where development partners can come in. So in programs where you have private sector leading the sector, be it off-grid or mini-grid, I don't think there is a massive distinction from a financing perspective. Of course, the devil are in the details. There are some, just selling a system to one customer is a relatively more straightforward transaction than selling a mini-grid to a community with a couple of thousand of customers at the same time. But those are issues that have been addressed, but it does impact the risk profile and appetite from financiers.
Yeah, and we'll hear from our G4A team about the different structures that G4A is encouraging for local lenders to support the PAYGO sector and support the mini-grid sector, because the types of loan facilities that these two different subsegments need are quite different. So that's a good segue into our next panel. So Tatjana and Jan, thank you so much. We hope you can stick around for the rest of the event. I want to introduce our Crackerjack G4A team in Lagos. G4A is managed by an all Nigerian team, an all African team, led by Sunkami Alowo. Sunkami has spent a 20+ year career before joining G4A as a banker managing the SME loan department of EcoBank Nigeria for many years, and initiating what were the very first renewable energy loans by a local lender in Nigeria some years ago. Koye Alaba is our chief financial analyst. He's been with us for 6 or 7 years now and is responsible for the development of the financial structures of G4A. And Ezine Okafor, who is a junior analyst with our team in Lagos. I turn it over to you, Ezine, to kick it off.
Thank you, Chris. I'll be walking us through G4A solution. G4A solution is the first loss cash deposit fund product. G4A will be primarily focused on providing cash deposit funds to qualified lenders. This includes financial institutions and microfinance institutions to enable them to provide local currency lending to off-grid energy companies and their customers. This would mean increased local currency lending support to energy access loan portfolios. Now, to mitigate risk, G4A will provide a maximum cover of up to 20% of losses in a portfolio of energy access loans. The exact percentage of coverage will be negotiated with each partner financial institution. And since experiential data shows that net losses are typically lower, G4A will effectively be covering 100% of the potential loss. The deposits of up to 20% of the projected loan portfolio will be placed in a specialized account. This is known as the Cash Deposit Fund, or CDF. These accounts will be domiciled at the partner banks and it will be available to draw upon to cover up potential losses of the portfolio. As part of technical assistance, G4A will provide support to partner banks in seeking off-grid enterprises with quality deal pipelines, and G4A will help to facilitate the partnerships between the banks and the companies. Now I will hand it over to my colleague Sukomi, who will walk us through how CDFs cover losses and the process of establishing CDFs.
Thank you, Ezine. You're all welcome. I'll be speaking on how G4A helps cover losses. G4A, the essential thing we're doing in G4A is to ensure that the financial institutions who hitherto has been risk shy in investing in financing risk projects in the off-grid energy. With G4A, we have substantially addressed the risk profile that comes with financial transaction. For an example, if you have a $10 million portfolio of energy, this $10 million portfolio, if you compare it to the risk that is currently being covered when you use a pari passu guarantee. I saw a question on the chat room just now asking about pari passu guarantee. With a pari passu guarantee, if you have a 50-50 coverage, which means that 50% of the loss is borne by the guarantor and 50% of the loss is borne by the bank. If there is a default of $2 million, the bank will bear $1 million, while the guarantor will bear $1 million. But with G4A, with a 20% coverage, we will be covering the whole $2 million since it is within the limit of the coverage that we offer. That's why with G4A, the bank will not have to bear any loss on a default of $2 million on a $10 million portfolio. That's a powerful tool that we are bringing to G4A. Please, can you give me the next slide, please? Now, what type of project do we support? We support lending into consumer loans and lending into project finance. Under consumer loans, our guarantee, our we support solar home systems. It also support solar for healthcare system. It also supports solar for productive use of energy. And under the project finance, the mini grids are covered under the project finance. I'll then be speaking, how do we ensure coverage for each of these specific segments under G4A? The next slide will be talking about how we support lending to consumer finance. Under the consumer model, please can we have next slide, please. Under the consumer finance model, the pay-as-you-go company is best suited to deploy their system. But what you find happening right now is that they are using their balance sheet to lend, and that constricts their ability to do transactions. So right now, with G4A, what will be happening is that the pay-as-you-go company will be focusing on origination of transaction, will be focusing on deployment of system, they will be providing warranty and O&M services. Now, when a consumer needs a financing, a bank will be there to provide direct lending to the consumer. And when the bank is financing, the bank is best suited to look at the risk, and the bank is comfortable to finance because G4A will put behind the bank the CDF, which is a cash deposit fund. With the strength of the cash deposit fund, which is an on-balance sheet fund that is made available to the bank is able to lend, knowing fully well that within the loss coverage, there is a default, it is covered by G4A. Apart from that, there's also a technical assistance that we put in place for this process. Listen, can we look on the next slide? We'll be talking about how we look at mini grid. Under the mini grid model, we're using the cross-boundary, it's a structure that is similar to what cross-boundary is currently using, which is available in the NEOT winch energy system, similar to it. And how is it? Mini grids are built whereby we then aggregate this mini grid, aggregation the mini grid into what you call an asset pool. This asset pool can then be used to borrow such that the bank that is supporting is not supporting just one mini grid, but is supporting a range of mini grid that has been bunched into an asset. And why is this structure? This structure eliminates the developer's risk that is associated with setting up a mini grid. But the developer still have a skin in the game because there are certain agreements that is made on revenue collection, on connection of number of connections that is on the system, and some other variables along the line, which ensure that the operator, which in most cases is the developer, but it could be another operator, is able to ensure that it focuses on the operation of the mini grid, which has been bunched to an asset pool. G4A will then be able to make available the cash deposit form to the bank so that the bank can support the asset pool to be able to buy these mini grids, which have been aggregated into an asset pool, and then the developer can then go back to build more mini grid, which can then be aggregated into an asset pool. And it continues like that. And with that, we'll be able to expand lending into the mini grid space. This is the structure that we are bringing to be able to support mini grid. Next slide, please. Now, in doing all of this, what do we charge the company, the bank? The FI, to be able to have the support of G4A, will be paying a fee. And this fee is an annual fee, which is between 1% to 2%, depending on what we agree with them. There are other fees that will be agree with the bank that is into this space. But this is done in such a way that the product does not become too expensive for the bank to do. And with this, we'll be able to ensure that we generate enough returns to our funders, and we generate enough return to ensure that G4 is a sustainable business model. I'll be handing over to my colleague Koye, who will be speaking about what are we asking the investing community, what is the returns that we are expecting, and how do we ensure that G4A is able to return and make adequate returns to the provider of funds. Koye.
Thank you, Sukumi. Moving on quickly to the structure of the fund. G4A has been designed as a 12-year closed-end fund with a total capitalization of $50 million, comprising of 3 tranches of capital, namely $20 million senior debt, which we expect to be provided by DFIs and private impact investors, a $20 million concessional junior debt tranche, which will be provided by philanthropic or public funds and private high impact investors, and 10 million in grants, which will be provided by philanthropic and public funds. Both the senior debt and the junior debt have been structured such that they will not amortize annually in order to allow for maximum impact through continuous redeployment of capital over the 12-year horizon of the facility, meaning that the lenders will receive interest-only payments up until the liquidation of the fund at the end of year 12, when they will receive a one-time bullet principal repayment. And in terms of interest, the senior lender will receive annual interest payments at 2% per annum. The yield on the junior debt is lower because we expect that it will be provided by philanthropic funds most concerned with capital preservation and impact. In addition to that, we believe that the cushion provided by the grant tranche and the 80% first loss guarantee to be provided by CEDA on the junior debt will make the concessional terms acceptable. And the full 50 million facility will cover the 15 target countries shown on the map on the right, which were identified during our market assessment. In addition to the $50 million facility, an additional $5 million grant is needed for a parallel technical assistance facility. And GreenMax will serve as the fund manager with an annual management fee of 2%. Next slide, please. And based on discussions that we've had so far with potential funders, it is anticipated that G4A could reach an interim first close of $5 to $10 million by Q3 2021 to kickstart the pilot CDFs already arranged by GreenMax in Nigeria, Uganda, Tanzania, and Malawi. The first closed capital structure, the interim closed capital structure, will comprise of only 2 tranches, grants and concessional debt. The concessional debt provider will receive interest payments at 2% per annum with 80% first loss guarantee provided by CEDA. Next slide, please. As previously mentioned, due to the long time it takes to reach financial close for a fund entity such as G4A, we have set up pilot CDFs with 4 FIs and 1 MFI to serve the existing pipeline of deals already identified. Each pilot is being organized as a standalone cash deposit facility and an individual investment opportunity, which will be rolled up into the full G4A facility. The total funding need for the pilots is about $3.5 million, which would catalyze about $17 million in energy access loans. Next slide. We have developed a detailed financial model for the facility, and this slide shows the results of the base case scenario. I should state up front that due to the first loss nature of G4A and constraints on the level of fees we can charge our partner FIs in order for them to remain competitive in the market, the returns generated by the facility are quite modest, with a senior debt IRR of 4.3% and junior debt IRR of 2.3%. And this projected figures are inclusive of residual cash available after full repayment of the senior debt and junior principal, which will be distributed to the lenders, given that both the senior and junior lenders will be bearing equity type risk. A small fraction of the residual cash will also be awarded to the fund manager as an incentive to ensure optimum performance of the fund. Next slide. And in terms of impact, the 50 million G4A facility is expected to catalyze nearly 900 million in local currency denominated energy access loans in Sub-Saharan Africa provided by local banks over its 12-year life. This will translate to an overall leverage ratio of about 18 times and the deployment of 2 million off-grid energy systems with a total capacity of 175 megawatts. I will now hand it back to my colleague, Ezine.
Thank you, Koye. GreenMax has the right background and experience to make all this happen. We have 26 years of experience in clean energy investment advisory across 80 countries, and we have been working in Africa since 2005. In the 2000s, GreenMax successfully launched and managed first loss facilities, which helped to create a commercial lending market for energy efficiency improvements for blockhouse housing cooperatives in Eastern Europe. And as a result of this, today, banks there are able to offer loans in this market segment, which are worth about $300 million annually. Our core team in Nigeria is comprised of experienced bankers, financial analysts, and energy access professionals. Next slide, please. Please make sure to get in touch with us at these contacts and support us while we do the work to bridge energy access gap in Sub-Saharan Africa. Now, the next session will be focused on hearing from the companies in the PAYGO space who will explain their financing needs and how G4A can help address these needs. We're grateful to have GoGlass sponsor this session, and I will now turn it over to Rowan Boss, who is the session's moderator. Rowan is a project manager within the performance and investment team at GoGlass, with a focus on access to finance. Through her work, she defines and promotes adoption and harmonization of new standards and metrics, with the overall goal to strengthen company performance and unlock additional financing. She also contributes to enhancing market insights and promotes knowledge exchange around new or lesser known financial instruments and services and company performance and profitability. Thank you, Ron, for hosting this session. And Antonio, over to you.
I think everyone is able to see and hear me now. Let me know if not. Thanks a lot, and thanks for the opportunity to also moderate this session. I think it's hopefully going to be an interesting discussion for you all. I just want to start the session actually by saying that I think last year for the ODS sector, for the off-grid solar sector, we've been actually lucky enough to attract about $316 million in capital. Yet that is, on the one hand, a very positive sign, of course, and it shows that there's a robust investment going into the space, and that also current investors are supporting the off-grid solar companies. Yet, if you dig a little bit deeper into that data, we can also see that on the one hand side, also that financing is going to kind of the top 10 and the top 3, with, even though it is improving, about 70% of that capital is going to the top 10 companies in the sector, and 40% is going to the top 3. So on the one hand, we need more kind of distributed financing, and we also need more financing in general. We're currently at about 316 million, but we need to reach to a goal where we have about 1.1 billion of financing going into the space to be able to reach SDG 7. So I'm very excited to have this panel today and talk about the solution, and also how we can make sure to actually expand that pool of financiers and make sure that the companies are getting the financing that they need and the opportunity for them to grow. So today, I have 4 panelists. I have Federico Hendrik from GDC, and GDC, in case you haven't been familiar with them yet, they're an association dedicated to supporting and representing last mile distributing companies to help them reach underserved customers with life-changing products, such as off-grid solar products and clean cook stoves, water filters, etc. And they're also aiming to developing the last mile distribution sector as a whole. GDC currently has about 200 members all over the world, and Federico is working on GDC's access to finance activities, so helping members connect with funders, helping funders better understand the last mile distributing sector. And they've also recently finalized a research piece around growth and fundraising journeys of last mile distributors, which was also presented in a forum last April. The event was attended by about 100 funders with the objective of developing and taking forward concrete solutions to overcome access to finance challenges. Federico will walk us through some of those main findings of the research and also conclusions of the forum. Then Vivian Pat. Vivian Pat is a CFO of Simo Solar, a productive use distributor and financier of solar-powered equipment company in East Africa. Vivian has 20 years of international experience in finance, Singaporean born and bred. After articles at KPMG, she moved to London to work in wealth management. And then over a decade, she moved to the Netherlands, where she joined an impact investment advisory firm with the mission to mobilize capital from large Dutch pension funds into more impact funds. Vivian then saw a vast opportunity to, in sub-Saharan Africa, uprooted her whole family to go to Uganda, where she is now, and she was also the CFO for the largest private medical group before joining Simo Solar in 2019. Then Anton Aspira. Anton is one of the co-founders of Solibrium, and he oversees all growth and corporate strategy in the company. A Kenyan native, Anton is an entomologist by training with a PhD from the University of Oxford and has worked from academia through applied research to industry and entrepreneurship. He is also co-founder of an award-winning biotech company based in San Francisco and Malaysia and focused on early-stage drug recovery. And the co-founder of Solibrium awards-winning parent company EcoSolibrium, through which he has over more than 10 years of experience in natural resource conservation and social enterprises in rural settings in Africa. And then the last panelist, Remco van der Riet, and he has over 10 years of corporate banking and startup experience. He's currently the director of corporate finance at Zola Electric, a scalable energy solutions company providing solar and smart energy storage solutions which aim to power millions of households and SMEs in Africa. He also served as an independent corporate finance and strategic advisor, where he acts as the main financial advisor for 15 to 20 Dutch and Senegalese SMEs on a recurring basis. Previously, Remco spent 5 years at ING as a senior consultant on acquisition finance and structured lending, where he originated and structured financing packages for both corporate and private equity funds. So I'm very excited to have all the panelists here today, and I would actually like to start with the session to hear a little bit more about GDC's report. So I would like to invite Federico to hear from him what has been kind of some of the key findings from that report, and to set the scene a little bit.
Yeah, thanks, Rowan, and good day to everyone. So, I mean, seeing that access to finance is one of the top barriers faced by the GDC members and last mile distributors in general, we at the GDC started looking into this question of access to finance to see what we can do as an industry association, and have been discussing with donors and investors about this for the past 6 months. And one of the things that emerged from these discussions is that investors and donors need a better understanding of the last mile distribution sector to know how companies grow, how they finance their needs, the impacts that they generate, and the challenges that they face. And that is why we conducted this research on the growth and fundraising journey of last mile distributors, which I'll refer to as LMDs from now on. And this research was based on in-depth interviews with 21 of our top performing members. Solibrium, represented here by Anton, was one of the interviewees. And then some others that you may recognize are Vitalite, which was also cited before as one of your pilot projects, and then Ulu Solar in West Africa, or Zonful in Southern Africa. A slight caveat is that our members are primarily distributors, not vertically integrated off-grid solar companies, but most of them do provide consumer financing, and they act as pay-as-you-go companies. So this is relevant for the topic of our discussion today. And I would say some of the key findings of this research that are relevant for this discussion is one, that working capital financing is absolutely critical to sustain operations and growth. That is obvious for, I guess, everyone in this room. But then of the debt that these LMDs have been able to raise up to now, local financial institutions represented only 1% of all the debt that these companies get. So practically negligible. Most of the debt that these companies are being able to raise comes from crowdfunding platforms or specialized debt funds like the Sunfunder, SEMA funds, etc. And some of the main challenges that these companies are facing with regards to working capital financing are, on the one hand, and here I mean, we divided our sample into two different categories. One is the faster growth distributors, which are these companies that look for scale and international expansion from the beginning. And then a second category was slower growth companies, so the smaller ones that look for profitability before scaling up significantly, which also play a crucial role in the sector. And we did this to understand the needs and the challenges better. So for the faster growth group, we found that debt is very quickly constrained by the balance sheet of companies or by the available equity, and that equity is getting increasingly harder to raise as companies grow. We've heard that VC investors in the space are not seeing profitability with scale in these companies and are a bit more hesitant to invest going forward. And this is a major blocking factor for these companies to sustain operations and sustain growth. And then for the smaller growth category, what we've heard as a main challenge is that they need a very long track record. We're talking about years and years of bootstrapping before they're eligible for loans from different types of institutions. There were other top challenges that were mentioned, and these include, for instance, the difficulty in accessing large debt facilities that provide capital with debt capital with the continuity that companies need, and not having to raise small amounts from multiple different sources and do that very frequently. Then currency and convertibility were another major concern, depending on the country of the distributor. And then lack of interest of local banks in off-grid solar companies is it's primarily a frustration of locally owned and led distributors among our members who have. These are companies that typically have a harder time trying to access international sources of finance, so not being able to get their local banks engaged is quite a big frustration. So I'll stop here for now and see what others have to add to this before I continue talking about this research piece. Thanks.
Thanks a lot. I think it was a really, really good overview, and I think a lot of the challenges that our panelists will recognize. So I was actually wondering for Vivian, maybe you could respond on that, whether those are some of the challenges that you also face as perhaps a little bit of a different company as well, being in more productive use. So just want to hear from you how that compares with the realities you face, and also in general, how has been your growth and fundraising journey so far.
Unfortunately, it looks like Vivian lost her connection.
Okay. Well, no worries. Then I'll ask the same question to Anton.
I guess it's my my lucky morning. As Federico mentioned, we were one of he interviewed, and the challenges that he outlined pretty. I mean, it's exactly what we face. Because on the last one he mentioned, the lack of interest from local LFIs. Our local LFI partners, banks that we deal with, they are very interested in what we do. They just don't have the institutional or infrastructural capacity to support us. Right now, it's a very good example. We are working on securing an export credit, and our local bank is very interested in helping us. It's just not able to work within the requirements of the export credit facility that we are targeting. So much so that we have to turn to an external guarantor, which completely complicates the matter. So I think, what you guys are doing right now in helping LFIs to be able to support local oil companies is a big step, because I think the interest is there among LFIs. They're not able to take the risk, or they don't have the institutional ability to do so because they just haven't worked space before. I won't take up any more time, but I think I just wanted to mention that.
Yeah, and then maybe from your perspective as well, as perhaps a little bit of a bigger company in the sector.
Yeah, thank you, Rowan. Good being here. I think the access to finance is less of a problem for the bigger companies, because they have access. The ticket sizes are large enough to access the funds that Federico also mentioned, the Sun funders, the CIMA and the likes. If you zoom out a bit and you look at this sector, it's still a very young sector, but if you want to set it up for real growth and to access, make sure that we reach the number of connections we'd like to reach everybody, both access to energy and providing people with energy that have weak access to energy. I think we need to set up this properly, and therefore also we need to take into account the cost of capital. And therefore, if you look at the companies that can access capital, they're often financed by VCs, and their cost of capital is enormous. And therefore, I think it would be very beneficial if we not start converting dollar VC money and dollar fund money in local currency, but actually take the local currency loans where the money already is. And therefore, I really love the idea, the fund what G4A is doing, and I see definitely all the benefits there.
Thanks. And I think Vivian is back. I'm just checking if she's back or not. Giving a few seconds.
Yes, she is.
She is. Are you there, Vivian?
Yes, apologies.
You're back again. Good that you got connected again. So we're just trying to setting the scene a little bit and hearing from you what has been some of the key challenges for you kind of within the organization, and how has been kind of your growth and fundraising trajectory. So it would be nice to hear from you whether you have faced kind of the similar challenges as the other companies, and also recognize some of the key findings, or whether you have faced any kind of additional challenges.
Yeah, so maybe raising journey. We in CIMA Solar, we distribute and we provide paper financing. We started in Mwanza on the Tanzanian Lake Victoria side in 2014 with solar fishing lights before we expanded into solar water pumps. And sort of towards the end of 2019, we got a grant from Carbon Trust and we expanded into Uganda. So we were able to start up our operations with a mixture of grants and concessionary debt. And that went into the development of our IoT platform. And I guess year on year, we've been doubling our top line revenue. And now we find ourselves in a scale-up phase. We have been able to raise debt funding from a crowdfunding platform. And we've also been quite successful in raising quasi-equity in the form of convertible notes from impact investors. And we're lucky enough to sort of close that round at the height of the pandemic last year. So even though we were successful in raising and fundraising, I mean, we do find that the capital cost is expensive, and it usually comes in the form of very high front-end fees. At some point, we were paying sort of 5 to 6% upfront fee for a 2-year loan. The interest rates were high, and we couldn't match the short-term loan tenor with our longer-term receivables. And like a lot of others, I think we also faced the challenge of being able to borrow in local currencies. So we have only been able to access hard currencies. And currently our loan obligations are made up of a mishmash of US dollars, of euros, of pounds. And our income stream is in local currency. So we do have a significant sort of currency risk exposure. We have managed to access a small local currency loan in Uganda and in Tanzania. Obviously, if you look at our loan portfolio, we would prefer to have greater access to local currency financing.
Yeah, and then for you and kind of the experience that you have, or maybe looking forward as well, what would be some of the benefits actually of working with a local finance institution beyond, obviously the financial aspect to it? Sorry, Vivian. Otherwise, I'll switch it over to Remco. Remco, because I think you have also in the past worked with some local financing institutions as well. Wondering from your perspective, what has been some of the benefits beyond kind of just the financing aspect?
Yeah, I think, want to emphasize again, the financial aspect is the main benefit, yet you also have the different aspects. If you look at our partnership with Sterling Bank, for instance, in Nigeria, I can leverage outreach to different clients and therefore kind of promote your products and see how you can build a true partnership there. And I think there's also benefits for banks actually to better understand the underwriting and origination principles that the off-grid sector actually developed, which is, I put it nicely, it's more 21st century than some of the banks currently have in place.
Mm-hmm. And I see that we have only about 10 minutes left, so I also want to make sure that we ask some of the questions from the audience actually. So we have here a question from Richard. The capital structure of the fund is very dependent on grants and soft loans, and there is no equity from the sponsors in the fund. And I think this could be an issue actually with closing. So perhaps, I don't know for who it would be best placed, perhaps for Federico to respond on that. How do you view this?
Yeah, sorry, I probably am not the best place to answer that question because I'm not a financing expert. I think that question would be great for the G4A team to address, because I'm sure they've given this some thought. So I don't want to answer on their behalf.
Okay. Other than that, I don't really see any questions from the audience. If you do have a question, please pop it into the chat. Maybe then staying with you for kind of when implementing the G4A facility, in your perspective, how could the fund be critical in actually accelerating some of that funding going into the space?
Sorry, that question was me?
Yes. So in your perspective, how could implementing such a platform, the fund of the G4A fund, and implementing the first loss facility, how could, in your perspective, that accelerate some of the funding that is going into the space, and how would it be critical to implement that at this point?
Well, I mean, first, the others, everyone has said it, local currency is certainly missing. The banks do have a critical role to play in that area. Then you've also mentioned how the facility has this potential of having banks act as direct financiers of customers and taking off that debt from the off-grid solar companies' balance sheet. Both of these things I find to be critical and very interesting for the sector. With regards to how to do it, think it was interesting that Tatia mentioned before that the World Bank has tried credit lines with local financial institutions and has included risk mitigation instruments like partial risk guarantees in the past, and has a lot of lessons learned coming from different countries. So probably the first step would be for this facility to make sure to take into consideration all the lessons learned from the previous attempts of the World Bank and the likes to include the local financial institutions but to get them engaged into lending more into the sector. And what you've mentioned about providing a first loss guarantee that covers 100% of that loss is something that I have not seen before, and will certainly catch the attention of the banks. Again, referring back to Tatia, there are lots of things to try. So I think it's very exciting to see that you're trying this out, and to see how it works.
Mm-hmm. And
may I say something, please? Sorry.
Go ahead. Yes.
I was thinking that this actually offers an excellent opportunity for local LFIs, because we in the pay-as-you-go sector, we collect a lot of information about our clients to their payment systems. We have a lot of information about their behavior on how they utilize their electricity. We see the potential for a lot of upselling of products. People step in with a 4-light system. Within 2 years, they upgrade to a television. Within 2 years, they're looking for a refrigerator. All this provides a massive opportunity and lots of potential information for LFIs that haven't been able to access this information previously as customers go into the digital economy. So I think there's a great opportunity here for LFIs to coordinate with last mile distributors to piggyback on the CRM platforms that are used in the pay-as-you-go sector to start penetrating the market for financial services for clients that go well beyond just paying for their small solar home system. So I think there's great opportunity here, and I think I hope the LFIs will recognize that and be open to partnerships within the pay-as-you-go sector.
Yeah. And then maybe also, because thank you for that, Anton, and I think there is definitely great benefits in terms of partnerships, and also for the companies, of course, to be able to financially sustainable and to be able to grow and to reach more customers. But what would also be interesting to hear, and perhaps for you, Vivian, if you're still on the line, is how important actually, for example, the interest difference and having kind of a local currency to work with, how important that would also be for the customers, kind of looking at whether it could decrease the product price, for example. Yeah, wants to hear your perspective on that.
Yeah, just from the perspective of the the product use asset space, I think generally we all know that financial institutions are they're risk-averse creatures. So the best thing about having a first loss facility provided to these financial institutions is very key to unlocking the LFIs to step into this gap in the energy access lending space. I mean, it'd be virtually impossible for a company like Siemens Solar to obtain, a straight commercial loan, because banks and the local banks here tend to favor land title as a collateral. And having, a facility at G4A will help the LFIs introduce a new product line of credit. But the main advantage of this fund is also to allow companies like the pay-go companies like Siemens Solar to bifurcate, our technical capabilities of delivering equipment to customers. The equipment that we sell and distribute to customers is really to increase their income yield. And with an increase in income yield, that banks are just so that banks are afraid of. It allows for off-balance sheet financing to be provided by the local banks. And banks, like what Anton was saying, they can reduce their credit risk by leveraging the platform that we have already created. For us, we can remotely track, we can control the equipment, and that can also be used as a collateral for the banks. And Simultaneously, at the same time, the local banks can also serve as a lead generator for companies like us, because of their, they have a big pool of agricultural customers that we can tap into. So it's, I do see it as a sort of a win-win situation for the banks for providing the financing, for paygo companies like us to provide and to serve the customer segment, and for the customers to be able to access financing at a lower credit risk.
Yeah. No, thank you for that. I see that we almost have to wrap up, but before we do wrap up, I just wanted to ask one last question to all of you. Looking ahead, maybe in 5 years' time, where would you like the sector to be in terms of financing, and how much how much involvement would you like to have of local finance institutions as well? Starting with you, Remco.
Yeah, in general, I think that all receivables should be financed locally. So there should be a clear split in what is your corporate level financing need, what is your, for the fully integrated companies, what is your product development, how do you finance that, which part is equity, which part is corporate debt, and basically all working capital should be maybe a minor portion on group, and the rest should be all in opcos and distribution companies, and preferably matched with currencies, that if you have your loan outstanding in local currencies, it should be financed in local currencies. It's simple and straightforward.
And for you, Anton? You're mute.
Yep, I have to agree. I think ideally would have receivables financed locally, especially by LFIs, so that they can take out, I mean, at least for smaller last mile distributors, we don't want to have the role of financial companies as well. We want to focus on the products, we want to focus on the distribution, on customer service. So if the burden of financing can be removed from us, that really helps. Ideally, just one more thing, I think the sector is maturing, and I think the future is more likely to be productive use technologies as well as larger systems. And again, these are probably best financed by local LFIs, especially productive use technologies, because they generate income that, as Vivian said, LFIs can actually track and benefit from.
Yeah, and maybe it's a nice segue to Vivian, maybe to add some words to that.
No, it's 100. I'm 100% agreement with Anton and Remco.
Perfect. And then some last words from you, Federico.
Yeah, in 5 years' time, it'd be great that local financial institutions get to understand the business of off-grid solar companies, get to appraise the risk correctly because of their understanding of the sector, and then to price their loans in terms that are affordable for companies, and providing tenors that are adequate for consumer financing and for those receivables accounts. And I think 5 years seems, considering all the support programs going on, is achievable, and I'm looking forward to that.
Yeah, hopefully we'll manage. I'm also with you. I feel like the sector is maturing, and hopefully we can put in place all the building blocks within the coming years, starting hopefully with the G4A fund. Yeah, my opinion, and also kind of from the conversation today, I think it will be key and could be really provide an accelerator to crowd in more local finance institutions, to also make sure that we build that understanding of them and build that interest, and yeah, hopefully mature the ODS space and make sure that we actually achieve SDG 7. So I leave it with that. Thank you for all the panelists. It was a quick session, but unfortunately we could talk more, but unfortunately we have to move on to the next session. So for the next session, I would like to introduce Joan Chak-Jensa from AMDA. Joan is a renewable energy finance professional who is at the forefront of driving decentralized renewable energy access in Africa. through creating financial structures to bring scale to mini-grid sector. She's leading AMDA financial advocacy work on tariffs, rollout of smart subsidies and structured guarantee products that will crowd in large-scale funding to mini-grid sector in Africa. She also has an extensive experience in grid-type power and has been involved in tariff setting and PPA negotiations of major renewable energy products in Kenya as chief financial analyst in KenGen. She's a future energy leader at the World Energy Council, a young African leader initiative, Power Africa, Women in Africa Power 2019 fellow, a mentor for the Global Women's Network of the Energy Transition as well. Yeah, I'll leave it over to you to get us through the next session.
Thank you, Ro, and it was an absolute pleasure listening to your session. And we've learned a lot about the changing landscape in the PayGo session. So good morning, good afternoon, everyone. It's an absolute pleasure to be a moderator for this session. And it's good to see the progression of the G4A. We've been in conversations with the GreenMax team for several months now. And it's really good to see how far all these discussions have gone to, and of course, the traction that this fund has received. So to start us off, I just want to paint a picture of the financing landscape within the mini-grid space. According to the mini-grid funders group, 2 billion has been allocated to the mini-grid space. However, only between 13 to 15% has been dispersed. And in looking at the local financing situation, of course, companies that invest in the off-grid renewable energy solutions in Africa have to contend with limited access to credit. And as a result, of course, banks really perceive lending to the mini-grid space as risky, and interest rates are extremely high in many markets. There are potential advantages, of course, of using local currency debt financing. And a key reason, of course, is the mitigating, that you get to mitigate the Forex exchange risks. And the purpose of this panel will be to present real examples, faced by the mini-grid developers and, when seeking financing. And G4A, of course, is coming on board to facilitate, by giving our, a guarantee product, and of course is there to alleviate these issues. I want to invite, I'm joined by a really nice panel of gentlemen who operate within this space. And I want to invite my panelists to then be able to help me to have a robust conversation around local currency financing. And I'll start by introducing Ashish Shretha from the World Bank. Ashish is an energy specialist at the World Bank SMAP program, and he leads a program on integrated electrification and is part of the core team of the global facility on mini-grids. He's responsible for the mini-grid component of the Nigeria electrification project, the NEP project, and is also designing mini-grid operations in Ethiopia and Sudan. Ashish, welcome. It's good to see you. Next, I'll introduce Jude Numfor. Jude Numfor is the CEO of REI Cameroon. He's an energy entrepreneur, a self-taught engineer with extensive experience in the solar off-grid space. Jude is a founder and the CEO of REI Cameroon, one of the leading solar mini-grid developers in Cameroon off-grid sector. Jude is a member of the IEE Smart Village and serves on the ISV governing board. His company is a member of AMDA, and Jude also serves as a board member of AMDA. Jude has presented in many international conferences, and I want to welcome Jude. Welcome. Next, we move to Ricardo. Ricardo is an energy access pioneer committed to ending energy poverty. He's a founder and CEO of Equatorial Power. Ricardo is also the co-founder of Enagro, a productive asset financing company. He's also a board member of Umeme, which is Uganda's national electricity distribution company. Jude, welcome. Ricardo, welcome. Next, I'll introduce Prosper Magali. Prosper is the director and founder of ENSO, and a company that has been in operation for 19 years and based off in Tanzania. And Prosper is also a board member of Alliance for Rural Electrification. He was recently elected to become chairperson of TAREA. Welcome, Prosper. Great. So to start us off, and being cognizant of the time, I'd like to to give my panelists just 1 minute to say something brief about their companies before we begin with the in-depth conversation. So we'll start with Ashish.
Thanks very much, John, for the kind introduction. Pleasure to be here with you today. As many of you already know, the World Bank is supporting the federal government of Nigeria with its rollout of mini-grids through the Nigeria Electrification Project. And we feel that it's one of the most attractive markets for mini-grids for a variety of reasons, including the fact that the regulations are really quite solid. They allow for flexibility in tariff setting, and there's the willingness to pay has been established with existing diesel generation and so forth. And so we feel that mini-grid companies are in a good position, are attractive investments in Nigeria, and we've set up a facility to support this rollout through the provision of grants. But this has to be complemented by other sources of financing, and I think this is the subject of the discussion today. So I'd be happy to dive into that further, but maybe over to the other panelists for now.
Thank you. We give Jude a chance. Jude, welcome.
Thank you. It's really nice to be here. I'm happy that Cameroon is on the list today. In most of these opportunities, Cameroon is one of the forgotten countries. So I'm really happy to be here. My company, IIC, we are a mini-grid developer in Cameroon, and we've been doing this for so many years. And we have we had and actually still have a lot of challenges raising capital and trying to scale the mini-grid systems that we're installing. It's really nice again to be here, and I'll share more as time goes on. Thank you.
Thank you, Jude. Prosper?
Thank you, John, and thank you so much for inviting us to be part of this very important discussion. So ENSO has been in business for the past now 20 years, providing EPC services for private and public facilities. So we are so much into the health sector, electrifying health facilities, also on the education sector, electrifying schools and colleges. Also on the water sector, providing solar water pumping solutions, as well as providing solar street lights. 3 years ago, we also went into the mini-grid sector, and we already have a portfolio of mini-grids on the ground and some others on the pipeline. So today's discussion is quite important, as we've been struggling raising finance for this obvious reasons that we are discussing today. Thank you so much.
Thank you, Prosper. Ricardo, over to you.
Thank you, John. Equally a pleasure to be here. Equatorial Power, in a nutshell, wishes to represent the new generation of mini-grids. I mean, to us, it's not so much about energy as much as it is about service delivery through infrastructure. We believe in integration. So whether it's at the mini-grid site level, an integrated service delivery, or whether it is integration with the utility in order to accelerate access, because let's not forget that the utility will continue to represent the largest amount of, let's just say, new connections each year in every country. So we really want to be a platform to enable this. We currently have operations in Uganda, Rwanda, and DRC. We're expanding. We work with ENGIE in Uganda and some other big names, but truth be told, what we're most excited about is the integration with utilities. And because today's about financing, inevitably there's a lot of, depending on each country, there's a lot of issues there. Local currency financing is one of them, but I would say in the order of priority, that becomes the key issue when the subsidy component's already taken care of. And I'm looking at Ashish and World Bank type programs, because without those, and there's very little space for anything commercial. So yep, very, very excited to get into the details.
Great, thank you, Ricardo. So to start us off, and I'd like Jude to give us a bit of insight, given that he's been in the market for close to 15 years. Jude, what are the difficulties, of course, encountered by mini-grid developers, when securing debt funding that complements the RBF funding, as Ricardo has just mentioned about subsidies? What specific challenges have you encountered, Jude, as a developer on the ground in Cameroon?
Thank you, Joan. I will start by answering from the bottom up. What are my experiences trying to raise debt financing? We started off in 2006, and at that time, there were very few mini-grids, maybe nothing at all, actually. And actually, they call me in IEEE Smart Village the great-grandfather of mini-grids, because at that time, when we started, really, it was really, really hard. At that time, too, what made us survive was that we were allowed to charge high tariffs. At the time, the government didn't have the regulation in place. And so we charged tariffs that allowed us to cover our costs and actually be able to grow a little bit. There's a saying that the poor person is not too poor to pay. It is true. A lot of governments feel that people are really, really, really poor in the villages and cannot afford electricity. But guess what? They're spending even more right now. And so what I'm seeing as a problem is actually regulation coming in these days, and they're pushing so hard on mini-grid developers that it's really, really hard to breathe. So in the beginning, we did not have that problem. And so we did not really need a lot of debt. But then as time went on and the government came up, like I said, we realized that we were forced to go really, really down on our tariff to a point where we took in our first debt in 2017. Now, what's my experience in this? It was really, really hard. We had to present a collateral it was a local financing institution, and we had to present a collateral that is landed, something that is immobile. And we also had to go through a very, very tedious due diligence process where we had to pay for this local LFI to come to site and see whether we're really worth the loan. And this was actually a very small loan. And we were paying interest of about 12% on the loan, 12% with other things like impromptu visits from the administration of the LFI and all of that. So it was really hard. And then we tried presenting to banks, to larger banks, and most banks, nobody wanted to even listen to our presentation. So we also decided to not care about trying international debt, because if our local banks cannot even listen to us, then it's needless doing that. And so it's been really hard. And as I talk to you, even on this program of G4A, I don't see Cameroon. And so it's really hard for developers like ourselves. And talking about RBF, again, Cameroon is not on the RBF agenda. And so we are struggling every day to try to survive. Having a vehicle that can support these local finance institutions to support us would really be great, because they are already supporting us. The challenges they have are that they don't have the capacity to continue to service the level of risks that we present to them in the development. So that's my take, and I think that we are not unique. This is what all developers are going through. And it gets to a point where you have to be at scale to attract the right kind of debt. And how do you even get to be at scale? You know, we need to start and help the people who are starting from zero to get to scale. So it's really a great initiative that G4A is coming up with. Thank you.
I can see Prosper nodding his head when Jude said that it's not, unique to his jurisdiction. Prosper, do you have something to add to weigh in on that comment?
Not much to add because, as Jude said, they are not unique because all developers in Africa, and I think in particular local companies run by indigenous Africans, this is a struggle we have been facing for quite some time. Sometimes you can imagine we are in business for about 20 years now. We have banking records, very good track records with our local banks. They know everything, they know our finances, but still it's very, very difficult for them to finance us. And I think most of the reasons have already been said, but I think facilities like what G4A are now coming up with were missing because the renewable energy or the DRE sector is still perceived to be new and very risky. And so this LFI do not want to engage into businesses which they are not aware of. So one thing that I would like to recommend is for G4A also to include in their package awareness to LFIs. I understand already they've selected the banks that they are going to work with, but I think we also need to take on board the rest of the LFIs. So at least to make them aware of the technologies, of the basics of the technologies, so that maybe in future, when even the G4A fund is growing, maybe in the future we can even bring aboard some more LFIs as well. So yeah, it's as Jude said, it's really, we are facing similar situations for most developers. And I think together with, I've seen in the pilot, most of the companies in the pilot stage, I don't believe they are facing this challenge to access finance. They are multinational companies, which already for them to access finance is quite easy. So I really wanted to see maybe in addition to the companies already in the pilot, a consideration of smaller local companies is very important as well.
Thank you, Prosper, for your comments. To move the conversation forward, and of course, based on the whole conversation of the mini-grid structuring under the G4A facility, I'd like to ask Ricardo, what are your thoughts, Ricardo, on the on-balance sheet financing that is, of course, currently within the mini-grid space? What are the challenges of raising financing on balance sheet? And what are your views on the off-balance sheet financing options? Of course, we've seen the cross-boundary, project financing, open access, platform for this structure, and also we've seen Winch Energy being successful and raising financing on an off-balance sheet methodology. Maybe you can answer that, Ricardo. What are your thoughts on balance sheet financing and, of course, the potential of structuring financing on an off-balance sheet basis?
Of course, John. So I think, I come from finance, and I think that this is just very simple stuff, right? We sometimes we like to get together in the mini grid space, and luckily this is on Zoom, but otherwise people would have spent money, flown to a location, donors would have spent a ton of cash that could have gone to fund mini grids in Cameroon or Uganda or Tanzania, right? Just to tell ourselves that we don't need on-balance sheet financing, we want off-balance. I mean, this is 40 years ago we knew that, right? And 20 years ago, and 2 years ago, and in 10 years, well, it's very simple stuff. So how are you going to ask a small company which is struggling to convince talent to work for, I'm sure Jude, like myself, like Prosper, you know, when you're hiring managers, you have to convince them and you pay them a little bit in cash, a little bit in motivation. And now that's your problem day to day. How are you going to service debt? You know, I mean, it's very difficult. So that's what I think about on-balance sheet. Off-balance sheet, well, sure, project finance only works if the project has a sufficient capacity to pay with receivables, right? And it's a simple concept, and it doesn't start on the debt structuring at all. It starts on regulation, because if you're not able, as Jude was saying, to charge a cost-reflective tariff, forget being able to service any debt. In fact, your equity is losing money. So it starts from regulation, first of all. Second of all, if there's not a subsidy component, and, you know, we can, like Ashish is designed and is managing, but you know, we've been asked through AMDA years ago, hey, what would you guys like? And everyone says, look, results-based financing works, and it works for a number of reasons, and it shouldn't be constricted to a country. It should be open to wherever there is equity willing to implement it, because the difference is, as a developer, you need to be good enough to structure a project to fund the project before you refinance it, right? So that eliminates all the sort of briefcase developers that governments are worried about. But then it gives you and your investors certainty that if you go out and find the sites, that subsidy piece is covered. I mean, we've got a pretty sophisticated financial model. We've got, you know, great people. But at the end of the day, there's this big hole when you look at it, and it's like, wow, do you really think you're going to get that much CapEx subsidy over the years? It's like, well, yes, is what we'll say. But the truth is, nobody knows. So I just want to put this in perspective. First of all, I think debt is simple and ought to remain simple. Second of all, it's a function of the regulation and then the subsidy, and then comes debt. It's priority number 3. And the only thing I want to say to that, it just comes down to the terms. I think everybody's agreed for many, many years that projects should be funded on a non-recourse off-balance sheet project finance basis. And when you talk about cross-boundary, yep, they've got an interesting system, but the truth is it's easy enough today. We've got similar stuff where you're selling the equity. Effectively, you don't own the site. That's different, right? What we're talking about here is owning the site and funding it with debt. I think there's plenty of interest in selling the site to somebody else and operating it. That's not really the point here. I mean, I would just focus on terms. Everybody knows that a mini grid needs a little bit of ramp up time. So you need a grace period. Everybody knows that if you give me 3 years to pay back debt as opposed to 30 years, that's going to put a lot of pressure on the tariff. So we need a longer tenure. No DFI is talking of above 10 years, including the grace period, right? There are funds that can go up to 15, maybe, but the 15, I would argue, look, we've got a concession at 20 years, right? Why don't we, you know, NGNL get money at 30 years? Why are we asking, essentially what we're saying is we're asking poorest Africans to pay for shorter tenure. Why? Is that not infrastructure that's going to remain? So I think that DFIs and the World Bank, with respect, need to start to think, okay, well, let's start matching the tenure, first of all, with the life of the license. Let's start there. Let's slap on 1 to 2 year grace period, and then we can talk about interest rates. And then we can talk about currency, because you know what? Most times the tariff is either in dollars if it's DRC, or it's somehow pegged to the dollar, because regulators know this. So it is a risk, but frankly, it's in the waterfall of risks, doesn't even come in my top 3 or 4. So that's a little bit provocative, but you know, at least.
Thank you, Ricardo. I'd like to bring in Ashish and to just comment on what Ricardo has said. And also, Ashish, I'd like you to really give us your experience on mini-grid developers, especially within the NEP project in Nigeria, has, you know, in terms of their experiences in obtaining local currency debt. And maybe you can paint a picture of how, you know, the World Bank NEP program is progressing, and of course, the challenges of developers within that space.
Sure, thank you, John. And first of all, let me say, I mean, I agree with just about everything Ricardo's just said. I mean, the reason we're so bullish on Nigeria is because, you know, we feel that the viability gap financing is there through the grant program. The regulations are fairly good. You know, the discos are unlikely to encroach on mini grids given their own struggles. The regulations also, you know, address what would happen if the grid arrives, etc. So, you know, so some of the risks are managed there. And I think this is validated to a large extent by the fact that we have been able to attract some of the leading international mini grid developers, as well as developing a large and growing cohort of local companies. And you know, my colleagues, Katya and Jan, have already spoken a little bit about this, so I don't want to repeat too much. But you know, today we're at about 375 projects in the pipeline, of which 64 have secured financing. And when we're talking about these 375 and 64, I mean, these are projects that for which the developers have signed agreements with the communities. They've actually designed, they have the technical design has been submitted for consideration. So these are, you know, fairly advanced. There is a, you know, a much larger pipeline behind that, which is still developing. Now, with that, I mean, you have to ask, I mean, why have only 64 secured financing? And for the most part, I mean, this is equity, convertible debt in some cases, and with a few notable exceptions, right? I mean, there's a few cases of local currency debt from commercial banks as well. But you know, and while acknowledging the key role that impact investors and you know, international investors have played in getting the sector this far, I think the scale of ambition we have, and we're talking many thousands of mini grids, is only achievable if we can unlock local currency debt. And I think there's a lot to unpack there. And you know, we've had discussions with mini grid developers in Nigeria that are participating in the program, as well as with local financial institutions. And we hold a series of roundtable discussions, some of which focus on how to unlock debt specifically. And you know, some of the things we've heard, I guess the two key things I would say is that the perception of risk is very high, you know, from with the local financial institutions regarding the mini grid sector. Partly because of the lack of track record. You know, many cases they don't really understand the sector very well, and this can be partly addressed by capacity building, right? And we're doing some of that. We have training sessions for banks and so forth. Also, institutions like AMDA, Cross Boundary, and others, I think they're, you know, collecting data, providing some empirical basis to understand performance of mini grids and how creditworthy they may be. And that I think will help in the long run. But right now, I mean, lending is still constrained because I think local financial institutions need some sort of risk sharing facility, a risk mitigation instruments. And it's unlikely that they will suddenly, you know, change course tomorrow and start lending without any sort of intervention. I mean, despite, let's say, capacity building and building the empirical basis for, you know, supporting the case for investing in mini grids. So that's why I think, you know, initiatives like G4A are so important for the sector in Nigeria. Now, there are several existing or other initiatives that try to fill, you know, this gap in debt financing. I mean, the Central Bank of Nigeria has set up a credit line. You know, it's part of the 5 Million Connections program. You know, it's a concessional facility. I think few lenders maybe can compete with these terms, but it's also quite restrictive. I mean, it's limited to Nigerian-owned entities. You know, there's borrowers have to basically, you know, put revenues and have to pledge the revenue into a dedicated account that goes first to the CBN. So for a number of reasons, I mean, a lot of potential mini grid borrowers have not been able to access this facility. Similarly, AFD has established a SunRef credit. That's another concessional credit line. And you know, this is channeled through 2 local commercial banks, whereas the CBN facility for mini grids at least is channeled through a special purpose vehicle. And here, developers have to go through like the bank's standard credit appraisal processes. And, and then we go back to the same issue. Banks are not as comfortable with mini grid sectors, and therefore they tend to require very significant collateral. And oftentimes that is really sort of where the discussion ends. And I think, the availability of a risk sharing facility, I would hope would allow banks to somewhat relax their collateral requirements and hopefully increase lending to the mini grid sector. Let me pause there, John. I'm happy to follow up, of course.
Yes, so maybe let me invite either Prosper or Jude to weigh in on that. Do you have any specific comments to what Ashish has said? And as you do that, I'd like you to probably provide your parting shots. We're in the decade of action, and when it comes to, of course, meeting the goals of the SDG. And as you're giving your parting shot, I'd like you to provide an overview of where you envisage the mini grid space to be in the next 5 years. So if you have any comment on what Ashish has said, you can then comment and give your parting shot. So we'll begin with Prosper.
Thank you, John. So I fully agree with Ashish's comments, and a very good example was here in Tanzania. We had a fund, a World Bank fund for a solar system, but it was not assessed by many of the companies here, because the banks where the funds were sitting just were offering the same conditions, the banking conditions to for the funds. So as Ashish said, the missing link was the risk sharing facilities, and we really appreciate what G4A are coming up with. So on what we envisage for the mini grid sector, I believe if we have the risk sharing facilities like what G4A are now coming up with, but on top of that, I've learned that there has never been any rural electrification program without subsidies. We have a big crisis here in Tanzania for the tariffs, and the government is demanding the national tariff to also be charged for mini grids. And I believe that unless we come up with subsidy facilities as well, to also combine with risk sharing facilities, then the mini grid sector will not be able to scale. So I believe, Ashish, you are from the World Bank, and you are quite aware with everything that goes on around the world. I really request that the World Bank and other DFIs also think that we really need subsidies for the mini grid sector. Thank you.
Thank you, Prosper. Jude, your parting shots are cognizant of the fact that we have only 2 minutes remaining.
Oh, okay. Thank you, Joe. I am, Prosper, what you said is really, really great. And I feel that also with Ricardo, the RBF as a support to the capital cost of doing these mini grids in the rural areas is really, really important. So I would really want to talk to Ashish and others here to say it is really important to roll out something like this to all the countries. And then a program like the G4A comes, like Ricardo said, as number 3. Thank you.
Thank you. Ricardo, your parting shots?
Yep. We are talking to DFIs about the terms of debt. So to stay on theme, I just hope that the fund gets structured in a way to not only cater for Forex, but terms. Terms are important, and tenure, I would say, has come probably first among them. So long term, and then local currency, and then good interest rate. That's what I welcome. And we're available to brainstorm with whoever's designing the fund and funding it. Thank you.
Thank you, Ricardo. Finally, Ashish.
Thanks, Joan. If I may actually just have a quick question for Ricardo. I mean, I was very interested in your comments about, I guess these are interconnected mini grids. It's something that we're looking at as well. And I was wondering, what has been the, I guess, response from financiers to your proposals for interconnected mini grids vis-a-vis isolated mini grids? Are they generally more receptive, have more concerns? How is it going?
Ricardo, half a minute response.
My assumption is that you're thinking of this as an asset, right? Because that's where we come from when we talk about mini grids. But the truth is we're also operators. So there's a more complex, how do you compensate for the asset model? And there's a maybe, well, less complex a euphemism, but there's a different model whereby you're operating. So effectively you're a concessionaire or sub-concessionaire. That seems to be quite interesting.
Okay, thank you.
Great. So it was an absolute pleasure to moderate this session. And thank you, gentlemen, for the thought leadership that you've shared on this platform. I'd like to hand this session back to Clifford. Clifford, thank you.
Thanks for a great job, Joan, and to all the panelists. We truly appreciate everyone who's attended today's roundtable, and especially those of you who have stuck around to the end. I want to give a huge thanks again to each of our co-sponsors, GOGLA, AMDA, and GDC, and all of our truly wonderful speakers for presenting such a strong narrative in support of launching a risk mitigation facility like G4A to engage LFIs in scaling up financing for off-grid energy. And most of all, I want to thank our GreenMax team, Koye, Sunkami, and Ezune, whom you've seen on screen today, and Alex, Lee, Cynthia, and Nathan behind the scenes for all their hard work in preparing this event. We know that G4A is only one small piece of the puzzle in reaching the massive financing needs for achieving the SDG 7 goals, but we hope all of you who attended today have at least these takeaways. One, African LFIs can play a critical role in the energy access finance ecosystem. Two, the past instruments for engaging LFIs to play a large role in the off-grid sector have had only mixed success. Three, a new intervention consisting of much stronger risk mitigation combined with robust technical assistance is definitely worth trying. 4, G4A is a well-developed facility with substantial support from the off-grid industry and from LFIs across Africa. And finally, we have a capable team at G4A with a track record to pull this off. Let me close by putting our impact slide on screen again, because I think this is a great way to close. We believe G4A will be truly catalytic. We expect our initial $50 million capitalization to leverage around $900 million in LFI lending. If we're right, and we've done something similar with the same product for blockhouse energy efficiency in Eastern Europe a decade ago, that'll be 18 times leverage overall. And if you're a grant provider, especially seeking catalytic impact, your funds will have nearly 90 times leverage. We really hope you'll find these numbers persuasive. So we hope you'll stay in touch with us and contact us at these metrics for further dialogue. We look forward to engaging further with all of you downstream. Our friends from the donor DFI impact community, please support us to help G4A meet its final fundraising hurdles. Our colleagues from LFIs, we look forward to working with you to build your portfolios of energy access loans. Our friends on the front lines of the off-grid industry. We're eager to link you with our LFI partners to explore new financing opportunities. Okay, and anyone who cares to take a deeper dive into the G4A structure and funding opportunity, you're welcome to stick around for another 30 minutes of Q&A with our G4A team. Thanks, and have a great rest of your day wherever you are.
For those that would like to participate in the deep dive Q&A, you can do so by raising your hand, and we'll give you the chance to turn on your camera and microphone and ask your questions, or you can also ask them in the chat.
Looks like Maximilian's got a hand raised.
Can someone raising up his hand? See that, Maximilian?
Yeah, please go ahead.
Maximilian, I think you're unmuted. Feel free to go ahead and ask anything if you had questions.
Okay, great. Thank you. Fantastic session. I wish you had the franchise to run a lot of these types of sessions that we get to listen to. It's very, very great learning experience. But the question is, so I think we understand, and we've had conversations before, sort of how the G4S scheme works, mechanically. But a question like, what other risks, if any, should we look at addressing together with this for this to be as powerful as possible? I mean, one could be political and regulatory risk on the tariffs, which could be a catastrophic thing. If you have a portfolio with a lot of mini-grid loans in it, statistically, some will go sour, and that is well covered by your 20% cushion here. But there's also the Armageddon type political risk scenarios where the tariffs of everybody is lowered to a completely unviable level, for example. Is that something that is relevant to address in conjunction with this, or is it better not introduced here so as to not make it too complex
Okay, I'll take a first shot at answering that, and then anyone else can chime in. When we set out to design G4A, of course, we're cognizant of the manifold risks in the sector, but we can't be all things to all people. We decided to try to address the overall underlying credit risk with this facility. Of course, you're absolutely right that the overlay of regulatory risk is significant. That's why we're trying to target G4A initially to those countries that we think have properly tackled those risks, and gradually expand as better regulatory frameworks are put in place in more and more countries. But covering political risks is the job of PRI, of political risk insurance. And certainly there's a role for blanket PRI policies to play in mini-grid portfolios. We, totally agree with that, but it's not something we feel can be bundled in together with G4A.
Thank you.
And there was a question in the chat from Jude about how did we qualify our first selection of countries to start in?
Koye or Sunkami, would you like to tackle that question?
Sure. Thank you, Jude, for that question. Mid last year, we had the market survey for G4A, and it was based on that survey and our discussions with potential partner FIs and local companies that we've selected the 15 countries that we are targeting. And so I know you had mentioned earlier that Cameroon is missing. And the reason for that is because we did not find banks in Cameroon that were ready and willing to be a part of the G4A facility and to partner with us. And so, so key factors that we considered in selecting the countries are countries where there is actionable deal flow and locations where we have ready partners in terms of local FIs. So I hope that answers your question. Thank you.
I think Jude also asked a question about how long will our pilot portfolio phase last. Honestly, Jude, that's a function of fundraising. If we could reach first close on the 50 million facility, before the end of the year, we would expand beyond those pilot portfolios as quickly as we could get the resources available to do so. With specific, respect to Cameroon, encourage you to work with our Lagos-based team, Koye, Sunkami, and Ezine, who you've seen today, and put them in touch with local lenders in Cameroon that you believe would be interested to collaborate with us, and we'll certainly consider them.
We actually have some. We actually have some FIs that we're talking to in Cameroon, and I'm sure that by the time we start, we should be able to tidy up some of those ones. There's some FIs that were in the initial assessment that we did in Cameroon. So Cameroon is not far.
Further questions?
I have one if nobody else.
Yes, go on. I might ask one too, just a quickie.
Oh, you go first.
Okay. I was just wondering, you mentioned you're doing some pilot projects, pilot facilities, in different countries. And I was wondering how those were going. And if you do close the bigger fund, will you roll the pilots into the bigger fund, or what would happen to the pilots?
Yeah, so the pilots are pre-funding also at this point.
Right.
They're pilots in the sense that we've reached agreements with the 4 FIs and 1 MFI in the pilots, and the companies have portfolios ready to go, but we're still trying to do an interim first close that would cover those 5 pilot portfolios. So, the only result we have is that, we've been able to negotiate deals with FIs. It's honestly taken quite a long time, but we have those agreements in place. And second part of your question, yes, absolutely, we will be rolling up those pilots into the full G4A facility.
Thanks.
Okay, has there been any indications that in terms of the terms and conditions, somebody raised it earlier in the call, that the LFIs would be willing to look at if they get this risk-sharing instrument, which is obviously quite powerful? I mean, reduced collateral, for example, interest rates is another one, or even tenor.
Yeah, yes, that's a really good question. So, we've been dealing with risk mitigation facilities for several decades in emerging markets, and what we've discovered, and is bearing true also in sub-Saharan Africa, is that risk mitigation initially gets you a couple of things, but it doesn't get you everything, right? So what it does get you is willingness to lend, where otherwise there was no willingness to lend. Secondly, dramatically reduced collateral requirements. So those are 2 big positives. And third, somewhat increased tenors. So we see that our LFI partners are willing to go out on pay-go for 36 months, where before they weren't willing to go more than 18, maybe 24 months. On mini grids, where earlier they were willing to not go more than 3 years, now we can get them to go 7 to 10 years. So those we think are big impacts. It's a long way on mini grids away from the 20-year debt that Ricardo pointed out is really needed. So we're a long way from that, and the only way we think you can deal with those kinds of tenors is by having DFIs provide credit lines of those tenors in local currency to the LFI, so that they'll more be able to originate, because their source of funds is not going to be more than 7 to 10 years ever. So only DFIs, we think, are able to provide that kind of tenor.
Oh, just as an aside, when we continue our conversations, and of course it's still a bit early, we can discuss what parameters can be calibrated and tweaked with our particular tool, which is only part of the equation. So that's something we can talk about going forward. So
right.
Just to say that the guarantees we're talking about is not set in stone.
Yeah.
If
right.
there is opportunities.
Perfect.
Thank you.
I see a question from Robert. Does G4A plan on providing capacity building to LFIs with regards to how the off-grid industry works? This was a gap noticed when the World Bank tried using LFIs in Tanzania. So, the answer is absolutely yes. Also from our long experience engaging with LFIs around the world, we know that engagement with them rests on a couple of different pillars. One is risk mitigation. Second, where there's low liquidity, is credit lines. And the third, and probably the most important, is a robust technical assistance intervention. And the goal of of G4A, or the goal of any intervention with LFIs, ought to be that after a certain amount of time, you're leaving in place the capacity for that LFI to operate business as usual in this market segment. So that means you're leaving in place confidence in the lending activity, because they realize that the level of risk, while significant, is not really so substantially higher from other business activities that they're engaged with. And secondly, that you've left in place a cadre of human resources, of people who understand how the off-grid business works, understands how to do credit analysis and underwriting, and how to do proper loan administration in this sector, and most of all, how to engage properly with whether it be mini grid or PAYGO partners with the companies in the space. So that's the goal, is true market transformation. In our work in Eastern Europe, it took 2 or 3 years only. I expect it to take longer in Africa, but we think that the same principles apply. Any other questions? We still have some time left for anyone who's interested. I don't see any more questions in the chat.
I have one, sorry, a lot of questions here. How do you steer the LFIs? You had the very interesting impact slide, okay, which of course has impacts in areas that SIDA is very interested in. Could you comment a little bit on how you steer the LFI lending towards these impacts? And ultimately, it depends on what sort of it's in their pipeline and their portfolio and what they actually lend to, I guess. But
right. Well, I mean, first of all, the key to successful engagement with LFIs is to not think you can recreate the lending institution. You have to tailor your engagement with them to what their main business activities are. So with a bank like Equity Bank, operating in Kenya, Tanzania, Uganda, and maybe another country or two in East Africa, they are traditionally a bank that is interested in consumer lending. So for them, the idea of using solar as the first step in building long-term engagements with rural customers, rural consumers, whether these be individual households or farmers or agribusinesses, to which they can in the future sell other financial products, whether that be tangentially related to energy, with appliances or productive use equipment, or whether it be for agricultural productivity products like high productivity seeds, etc. Whatever, when we engage with the bank, we figure out what's their business and how can the work that we're doing and trying to accomplish try to fit in with their business goals. If it's a bank like I&M Bank in Kenya, also operating in several countries throughout East Africa, they're mainly interested in corporate lending. They're not a consumer retail bank primarily. So, for them, lending to portfolios of mini grids is, particularly interesting. I hope that answers your question. I see there's another few questions that have come in. from Andriette, is the focus exclusively on the banks, or would it work for NBFIs or funds too? I'm sorry, what are NBFIs? I'm not familiar with that acronym.
Non-banking.
Non-bank financial institutions.
Yeah, insurance companies. Development banks. I don't know.
Okay.
Non-banking financial institutions.
So the answer to that is possibly, and the reason I'm hesitant is that while the ultimate risk is the underlying risk that G4A is covering is repayment by the customers. Our partner is the financial institution. So, we have to carefully due diligence those institutions. And at startup, we are limiting our engagement to those financial institutions that have had some relationship with DFIs in their recent history, either DFIs or in the capital structure of the bank, such as with our partner Equity Bank, or like with FCMB Bank and Sterling Bank in Nigeria. They have a long history of engaging with credit lines or guarantee products, so that, in a sense, we're piggybacking on the due diligence that's already been done by DFIs to engage with these financial institutions. When we get to NBFIs, that becomes a little bit dicier. But if we, can be presented with an NBFI like a leasing company that, meets those metrics, that, due diligence has been done to the satisfaction of DFIs in the recent past on, then, yes, we'd be glad to engage with them. Okay. Any further questions from anyone? I see we still have 25 people here with us, so glad for your participation to the bitter end. We have 8 more minutes, so please feel free to ask some further questions if you have any. Okay, it doesn't seem like anyone else is coming forward. So I guess we've fulfilled all of your questions, and I want to thank everyone again for participating. Please feel free to get in touch with us for further dialogue. Thanks again, and have a great day.
Thank you, everyone.
Thanks, guys.
Thanks.
Thank you.
Thank you.